Welcome to my presentation on liquidation accounts. In this presentation, I will examine the following. 1. Meaning of liquidation. Meaning of liquidation. Number 2, types of liquidation. Types of liquidation. Number 3, I will examine commencement of liquidation. I will examine commencement of liquidation. Then I will also examine the classification of assets, classification of assets at the same time, classification of liabilities on liquidation. Then I will examine in details the preferential creditors. I will examine the relevant dates of payment to preferential creditors. I will give the format for preparing the statement of affairs and deficiency accounts. Then I will also solve examination question as a work example. If you are coming across my lecture for the first time, please don't forget to like the video, subscribe to the channel so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you. Now, what is liquidation? Liquidation is the winding up of a company. The winding up of a company is said to be liquidation. In other words, the corporate life of the company is brought to an end and the company ceases to exist. When the corporate life of a company is brought to an end and the company ceases to exist, that is liquidation. What are the types of liquidation? For our purpose, we are going to categorize liquidation into 2. Number 1 is compulsory winding up, and number 2 is voluntary winding up. Another word for liquidation is winding up. I want you to know that liquidation is applicable to company. We use the term liquidation for company, while dissolution is used for partnership business. If it is a partnership business, so we use dissolution. The partnership business is said to dissolve. Both liquidation and dissolution have the same meaning. Only that partnership business can be dissolved, while company or limited company can go on what? Liquidation. We are on types of liquidation. Number 1 is compulsory liquidation or compulsory winding up. This can also be called winding up by the court. Compulsory winding up can also be called winding up by the court. When the court compulsorily require the company to go on liquidation, that type of liquidation is said to be the compulsory winding up. I'm not going to go into theory because my focus is the preparation of liquidation accounts. So that is why I'm trying to avoid the causes of compulsory winding up and those aspects that would be a bit theoretical. I'm trying to avoid that. Number 2 is voluntary winding up. This is the winding up by the shareholders and subject to the supervision of the court. Commencement of winding up. Now, I want to examine where the winding up is by the court. Winding up by the court. Winding up by the court. Court. What is the commencement date of winding up by the court? Number 1, it is deemed to commence at the time of presentation of petition for the winding up. So, winding up will commence at the time. Winding up will commence 1 at the time of the presentation. At the time of the presentation of petition. Time of presentation of petition for the winding up. Winding up shall commence at the time of the presentation of petition for the winding up. Number 2, if voluntary resolution has been passed for winding up before a petition is presented to court. At the time, if voluntary winding up will commence if voluntary resolution has been passed. If voluntary resolution has been passed has been passed for the winding up, or before a petition is presented to the court. Has been passed for winding up, but before a petition is presented to the court. Before a petition is presented to the courts. So that is for compulsory winding up, commencement of the compulsory winding up. The number 2 is voluntary winding up. Voluntary winding up. Voluntary winding up shall commence at the time of passing the resolution for the winding up. It shall commence at the time of passing a resolution. At the time of passing a resolution for the winding up. Classification of assets. Assets shall be classified into 2. Number 1, we have assets specifically pledged. Assets specifically pledged, and assets not specifically pledged. Assets specifically pledged are the assets that are used as a lien. Assets used as a lien for loans. Assets used as a collateral for loans. Assets used as a security for loans. You might have loan notes secured on land and building, e.g., loan notes secured on land and building. In this case, it means land and building is used as a security for loan notes. Take note of that. So that is assets specifically pledged. They are assets used as collateral for loans. Assets used as a lien for loans. Assets used as a collateral for loans are said to be the assets specifically pledged. Number 2 is assets not specifically pledged. Assets not specifically pledged are assets that are not used as collateral for loans. Assets that are not used as a security for loans. Those assets, we call them assets not specifically pledged. Any asset you see in question that are not used as a security for loans, no, they are what? They are not pledged. They are not specifically pledged as a collateral. Classification of creditors. or classification of liabilities. For our purpose, we are going to categorize the liabilities into three. Number one, we have secured creditors. Number two, we have unsecured creditors. Number three, we have preferential creditors. So, secure creditors are creditors that are pledged on a specific asset of the company. Creditors that are secured on a specific assets of the company. That is, the assets of a company are used as collateral for such loans. The assets of the company are used as a lien for such loans. We call them secured creditors. Then unsecured creditors are those creditors that are not pledged on creditors that are not secured. They are not pledged on any asset of the company. They are not pledged on a specific asset of the company. The assets of the company, no asset of the company are used as a collateral for such loans. We call them unsecured creditors. If the assets of the company are not used as collateral for those creditors, it's like you want to borrow loan. They ask you to use your car as a collateral. That means the loan is secured on the car. So take note of that. The number three is preferential creditors. Preferential creditors include all local rates and charges due from the company 12 months preceding the relevant date. I will still explain what relevant date means. Preferential creditors include, number one, all local rates and charges due from the company. All local rates and charges due from the company 12 months preceding the relevant date. 12 months preceding the relevant date. All local rates and charges due from the company 12 months preceding the relevant date. Number two, all payees accept taxes. All payee mean pay as you earn. All payee accept taxes, land tax, property taxes not exceeding 12 months of assessment preceding the relevant date. Property tax not exceeding 12 months preceding the relevant date. I told you I will explain what relevant dates mean. Number three, all deductions under the National Insurance Trust funds. All deductions under the National Insurance Trust Funds. Number 4, we are considering preferential creditors. Number 4, all wages due, all wages and salaries due. That is all outstanding wages and salaries. Number 5, all accrued holiday remuneration payable before or by the effect of winding up order. All accrued holiday all accrued holiday remuneration payable before or payable before or by the effect of winding up order, or payable before or by the effect of winding up order. Number 6. So, preferential creditors include all this. Number 6, amount due in respect of compensation. Amount due in respect of compensation. So, relevant date of payment to preferential creditors. I've told you I will explain what relevant dates mean in connection with winding up. Number 1, if winding up is by court, the relevant date is the date of winding up order. For winding up by court, the relevant date is the date of winding up order. We've examined two types of winding up. Number 1, the compulsory winding up, which is also called winding up by court. And number 2 is voluntary winding up. And I'm not telling you that if it is compulsory winding up, that is the winding up by court, so the date of the winding up order will be taken to be the relevant date. Number 2, voluntary winding up. For voluntary winding up, the relevant date is the date of the commencement of winding up. The relevant date is the date of the commencement of winding up. Accounts required. Number 1, we have statement of affairs. Number 2, deficiency accounts. Number 3, receivers or liquidators, receipts and payments accounts. Receivers or liquidators, receipts and payments accounts. Number 4, trading accounts. Trading accounts. Trading accounts is necessary where the liquidator carries on the business of the company, where the liquidator carries on the business, of the company. That is when you will need to prepare the trading accounts. So I want to start with number 1, statement of affairs. Statement of affairs in liquidation. This shows the financial position of the business prepared on a break-up basis at the date of liquidation. Statement of affairs. This shows the financial position of the business prepared on a break-up basis at the date of liquidation. Statement of affairs shows the financial position of the business prepared on a break-up basis at the date of liquidation. I've told you that this statement of affairs shows the assets and the priority claims of the creditors. It shows the assets and liabilities. So the assets and liabilities will be contained in the statement of affairs. It shows the assets, liabilities, and equity. I've told you earlier that assets will be classified into 2. Assets specifically pledged and assets not specifically pledged. This is the order of settlement on liquidation. Order of settlement, I am going to use this acronym, SEC, pre-debauch. SEC, pre-debauch. SE stands for secured creditors. Secured creditors. So, I've explained what this means. Creditors that are pledged on specific assets of the company. Then this one, C, stands for cost of liquidation or liquidation expenses, which may include legal costs, liquidators' remuneration, and any other liquidation expenses. So that will follow. After that, PRE stands for preferential creditors. Preferential creditors. That goes with that. That follows, After preferential creditor, debenture. But the debenture here is floating debenture. Then after floating debenture, we have unsecured creditors. After unsecured creditors, SH stands for shareholders. This group can also be called contributories. We don't call them shareholders, or you call them contributories. So this is the order of settlement. Format of statement of affairs. Format. So we have statement of affairs. I've told you you are going to categorize your assets into two. So we have assets specifically pledged. Let's have the estimated to produce. Estimated to produce. So assets. So we have assets specifically pledged. Assets specifically pledged. So by assets specifically pledged, we mean assets that are not used as collateral. Example may include cash in hands, cash at bank. I want you to know that it is the realizable value of the assets that will be used, not the book value. Please take note of that. The realizable value of assets is what should be used or what you are going to use in statement of affairs. Don't use the book value unless the book value is the same as the realizable value. Please take note of that. Now, motor vehicles, if it is not specifically pledged on asset, on debt, motor vehicles not pledged, or the motor vehicle not used as collateral. Furniture and fittings, the one not used as collateral. Then land and building not used as collateral. Then plant and machinery, the one not used as collateral. So assets not used as collateral are the assets not specifically pledged. So you have this as the total. Then we now have assets specifically pledged. Assets specifically pledged. By assets specifically pledged, we mean assets used as collateral. This is the total realizable value of all the assets. Let's have that as A. So the realizable value of all the assets, both the one specifically pledged and the one not specifically pledged. Sorry. This one is assets not specifically pledged. Not specifically pledged. While the second one is assets specifically pledged. I've told you that assets specifically pledged are the assets used as security for loans. One used as collateral for loans. Then we have liabilities. Liabilities expected to rank. Expected to rank. So I've told you the model or the acronyms to use is SEC pre the bunch. SEC pre the bunch. The CE stands for secured creditors. We are going to start with secured creditors. Those creditors that are specifically pledged on assets of the company. Then the C stands for cost. Cost of liquidation. Cost. And the cost may include the legal cost. Then liquidator remuneration. I've told you that this liquidator remuneration will be divided into two. We have the fixed remuneration and the variable remuneration. I will still explain how to calculate this. The fixed remuneration and the variable remuneration. The fixed amount will be provided in the question. The variable remuneration is usually calculated on the amount distributed to members. I will explain how to calculate this. Now, after C, we have pre. Pre stands for preferential. Preferential creditors. I've explained what this one means. I've explained preferential creditors. Those liabilities that fall within that group. Then we have debenture. The debenture here are the floating charge. So floating debenture. So that is the next. After debenture, we have the unsecured creditors. Unsecured creditors. Unsecured creditors. After unsecured creditors, we have the shareholders. I've told you that the shareholders are also called the contributory. Now, let's sum up all the liabilities. We have total liabilities. Let's have that as B. So, you now subtract all the liabilities from the estimated realizable value of the asset. Estimated surplus after settlement of all debts. So it may be surplus or deficit. Now, estimated surplus or deficit after settlement of all debts. So it is a surplus, that is A minus B, total realizable value of the assets, total realizable value of all the assets minus the total liabilities. That is what we give you this. It is a surplus if the realizable value of the asset exceeds the total value of all the liabilities. And it is a deficit if the liability is greater than the realizable value of the assets. So that is estimated surplus or deficit as regards after the settlement of all debts. Then after that, we now have shareholders. I've told you that shareholders are also called contributory. We have shareholders or contributories. Shareholders or contributories. Now, it now depends on the question. In some cases, you'll be told that preference shares are to be ranked in pari passu with ordinary shares. While in some cases, preference shares will be ranked prior to ordinary shares. Where preference shares are to be ranked prior to ordinary shares, that means the claims of the preference shareholders have to be met before the ordinary shareholders will be considered. Now, where preference shares are to be ranked prior to ordinary shares, we have preference shares. Then you have that. Then, if you have dividend due to preference shares, let me have arrears of dividends due to preference shares. Then premium on redemption of preference shares. Premium on redemption of preference shares. Premium on redemption of preference shares. This is where preference shares are to be ranked prior to ordinary shares. Remember, I've told you that where preference shares is to be ranked prior to ordinary shares. That means the claims of preference shares will be met before ordinary shareholders will be considered. Please take note of that. Now, after the settlement of preference shares, so if this is the total, we have preference shares, arrears of dividends, and premium on redemption. So this is the total of the three items. If you now subtract it from the estimated surplus after the settlement of liability, we now have estimated surplus as regards preference shares. Estimated surplus or deficit as regards preference preference shares. As regards preference shares, after the claims of preference shares have been met, then you now consider ordinary shares. Ordinary shares. So, after settlement of ordinary shares, you now have estimated surplus or deficiency as per statement of affairs. That is the format for preparing statement of affairs on liquidation. Remember, I've told you in some cases, ordinary shares and preference shares will be run in pari passu, where both ordinary shares and preference shares are to be run in pari passu. That means they will be considered settlement together. Preference shares will not be settled before ordinary shares, meaning that the surplus per shares or deficiency per shares as regard ordinary shares will be the same as the deficiency or surplus per shares as regards preference shares, where they are to be run in pari passu. They will lose the same amount per shares. They will gain the same amount per shares if it is surplus. You are giving them the same treatment, no preferential treatment. But if preference shares is to be run prior to ordinary shares, preference shareholders will be given the preferential treatment. Preferential treatment. Take note of that. But if they are to be run in pari passu, no preferential treatment will be given to preference shareholders. What ordinary shareholders will lose is the same amount preference shareholders will also lose, where they are to be run in pari passu. Before I consider the deficiency account, I therefore want to consider how to calculate the liquidator's remuneration. Liquidator's remuneration. Liquidator's remuneration will be divided into two. We have the fixed remuneration and variable remuneration. We have the fixed remuneration and variable remuneration. The fixed remuneration is a fixed amount which will be provided in the question. You'll be given that fixed amount that they are to be paid this so amount. The variable remuneration is usually calculated on the amount distributed to the members. Amount distributed to the members. To calculate the amount distributed, if you want to calculate the variable remuneration, amount distributed will be equal to total realizable value of assets minus total value of all liabilities. Realizable value of the assets minus total value of all liabilities will give you the amount distributed. After getting the amount distributed, you now calculate variable remuneration. Variable remuneration now will be variable remuneration will be percentage remuneration. Let's assume the percentage is X% over 100 plus percentage remuneration. 100 plus percentage remuneration times amount distributed. Amount distributed. I've told you that amount distributed will be calculated using this format. Total realizable value of assets minus total value of all liabilities. So if this variable remuneration is 2%, that means you are going to have 2 over 100 plus 2, which is 2 over 102 times amount distributed. Please take note of this. Deficiency account. Deficiency accounts. This account shows how the deficiency have arisen. It shows how the deficiency has arisen or have arisen. So it normally contains two things. Number one, we have items reducing deficiency. Number two, we have items contributing to deficiency. Item reducing deficiency are those items that will make the deficiency to reduce. Example, we have trading profit. Trading profit. Where there is a trading profit, profit will make the deficiency to reduce. Number two, estimated profit. Estimated profit from realization of assets. Realization of assets. Profit from sales of an asset. So we make the deficiency to reduce. Then interest income. Interest income, where there is or are interest income, and for the period, it will make the deficiency to reduce. Investment income. Investment income will also make the deficiency to reduce. Then discount on redemption of shares. Discount on redemption of preference shares. This will make the deficiency to reduce. Then we have costs in advance. Costs in advance. This will equally make the deficiency to reduce. These are some of the items that will reduce deficiency. On the other hand, we have items contributing to deficiency. These are items that causes deficiencies. Items that make the deficiency to increase. These are the items that will make the deficiency to increase. Number one, we have net trading losses. Net trading loss. If net means if there is a profit subtracted from the loss, you net them. Profits from the losses. So you get the net trading loss. Then estimated loss on sale of assets. Estimated loss on sale of assets. This will reduce, this will contribute to deficiency. Losses brings about deficiency. Any loss will cause the deficiency to increase. Then outstanding interest. Outstanding interest. Then when you have outstanding dividend, outstanding preference dividend, outstanding preference share dividends. This will contribute to deficiency. Premium on redemption of preference shares. Premium on redemption of preference shares. This will contribute to deficiency. Bills of exchange discounted. Bills of exchange discounted. This will contribute to the deficiency. Then contingent liabilities of which provision have not been made. Contingent liabilities on which provisions have not been made. being made. We mean items such as legal costs, e.g., legal costs, then liquidators remuneration, liquidators remuneration, then other liquidation expenses, other liquidation expenses. All these items will contribute to the deficiency of an entity. Deficiency account format. So you are going to start with items reducing, items contributing to deficiency. I've told you we have items such as net trading loss. Then we have outstanding interest. Let me just put interest. Then preference dividend, or simply dividends. Then exchange loss on exchange, estimated loss on sale of assets, non-current assets. Estimated loss on sale of non-current assets. Premium on redemption of preference shares. Premium on redemption of preference shares. Then you also have bills of exchange discounted. Bills of exchange discounted. We have contingent liabilities such as legal costs. You also have liquidators remuneration. Liquidators remuneration. Then other liquidators expenses. Liquidation expenses. We are still on items contributing to deficiency. Excess of liabilities over assets. Excess of liabilities over assets will as well contribute to the deficiency. So these are some of the items contributing to deficiency. So you sum it up. This is the total. Then after that we have items reducing deficiency. Item reducing deficiency. You have trading profit. If you have net it here, if you have losses and you net it, so that means it will not need to be here. But if there is no loss, then your trading profit, you have them here. Trading profit, then interest income, investment income, then estimated profit from sale of non-current assets, that is fixed assets. If I say non-current assets, I mean fixed assets. Then discount on redemption of preference shares. Discount on redemption of shares of preference shares. Then any other income. So you have them here. Then excess of assets over liabilities. No, excess of assets over liabilities is different from excess of liabilities over assets. So the total of all these, you have them here. So when you subtract it from the items contributing to deficiency, you have the deficiency as per statement of affairs. Deficiency as per statement of affairs. Example, on 31st March 20X4, Adegunle Company Limited decided to go into voluntary liquidation based on a unanimous resolution passed by its members in their last meeting. The following was the company's trial balance as at that date. You have ordinary share of 1 naira each, 200,000 naira. 10% cumulative preference shares of 1 naira each, 100,000 naira. Freehold properties, 180,000. Plant and machinery, 155,000. Investments, 28,000. Stocks and work in progress, 79,600. Receivables and payables, 58,400 and 97,000 for receivables and payables respectively. Trading loss for the year, 42,550. 8% debentures secured on freeholds, 80,000 naira. Cash in hands, 4,150. Call in arrears, advance, 6,000 and 10,000 respectively. Preference dividend half year to September 20S3, 5,000. Bank overdraft, 43,000 naira. Profit and loss account, 28,700. The total of both the debit and credit side of the trial balance is 558,700. Additional information. The company's assets are estimated to produce as follows. Freehold properties, 187,400. Plant and machinery, 138,900. Investments, 24,100. Stocks and work in progress, 62,700. Receivables, good, 35,000. Doubtful, 18,000. Bad, 5,400. B, the doubtful debts are estimated to realize 33 whole number 1/3 kobo in the naira, while the call in arrears failed to produce. C, the payables include preferential claims of 30,000 naira. D, the estimated costs and expenses of the liquidation are legal, 10,000 naira. Liquidators remuneration, 5,000 plus 5% of the amount distributed to members. E, the debenture interest has been paid to date. F, the preference share capital plus the arrears of dividend to date of winding up are to be settled at a premium of 3 kobo per share before the ordinary shares. G, the bank overdraft has a floating charge on the assets of the company required. Prepare the statement of affairs and deficiency account as at 31st March 20X4. That is the question. Now let's have the solution. Solution. You start with the name of the entity. Back to the question. We have on 31st March 20X4, Adegunle Company Limited. So you write Adegunle Company Limited. you are to prepare the statement of affairs. So we have statement of affairs as at 31st March 20x4. So I've told you that you are going to use the estimated realizable value of the assets, not the book value. Estimated to produce. Estimated to produce. Remember, I've told you that the realizable value of the assets will be used. The realizable value, not the book value. So you have the assets. So I've told you that number one asset to start with is asset not specifically pledged. Not specifically pledged. I've told you that assets not specifically pledged are the assets that are not used as collateral. They are not used as collateral. They are not used as a security for loans. Assets not used as a security for loans. They are the assets not specifically pledged. Now back to the trial balance. So you have cash in hand, 4,150. Cash in hands. Cash in hands, 4,150. So if you check these assets in the trial balance, these assets are at their book value. This is the book value of freehold properties, plant and machinery. I've told you that what you need is not the book value, but the realizable value. The amount you can get if these assets are to be sold. The estimated realizable value of the assets is what you need, not the book value. So we don't need the book value. So I'm not going to consider the value of those assets in the trial balance. The reason why I'm choosing cash is because they already have that cash in hands. Remember, even if you want to sell those assets you have, you are going to get cash from them. So cash is the amount you already have in hands. So other books value of the asset will not be considered. Bank overdraft is also a liability. Liability will not be considered yet. So we are dealing with the realizable value of the asset. Now, we have additional information. Then we have the company's assets are estimated to produce as follows. These are the realizable value of the assets. Now, which of these assets have been used as collateral? Now, we want to ascertain which of the assets have been used as a collateral. Remember, we are starting with assets not specifically pledged. If you look at the question, what are the liabilities we have? We have 8% debenture secured on freeholds. 8% debenture is secured on freehold. That is the only one that is secured here. So now that is to show that freehold properties has been used as collateral. Freehold properties have been pledged on debenture, on 8% debenture. So that is pledged. So other assets not specifically pledged now. We now have plant and machinery. So now let's have plant and machinery. Plant and machinery. The plant and machinery is the realizable value is 138,900. 138,900. It is the realizable value you need, not the book value. Then we also have investment. The realizable value of investment is 24,100. Investment. 24,100. So then we also have stocks and work in progress, 62,700. Stocks and work in progress, which is 62,100. 62,700. Stocks and work in progress, 62,700. Then we also have receivables. This receivable has been divided into three. Good, 35,000. Doubtful, 18,000. Bad, 5,400. So receivables. The good one is 35,000. So It has been divided into good, 35,000. Good receivable is 35,000. Back to the question. We have doubtful, 18,000, and bad, 5,400. Doubtful, 18,000, bad, 5,400. Then the doubtful and bad, if you sum it up, 5 plus 8, that is 13, 23,400. Now, out of this 23,400, how much are good? How much can you realize from them? So 18,000 plus 5,400, that is 23,400. How much can you realize from them? Back to the question. Note B. The doubtful debts are estimated to realize 33 number 1/3 kobo in the naira. So doubtful debts now. If you can realize 33 number 1/3, convert this to fraction. 3 times 33, that is 99. 99 plus 1, which is 99. 99 plus 1, that is 100. 100/3. So, no, it is in kobo. So, you want to convert it to naira. 100 kobo make 1 naira. So, that means you divide it by 100. So, if you have divided by 100/1, so we have 100/3 times. So, when division shifts to multiplication, then you are going to use the exponential of this function. 100/1. So, the exponential of it will now be 1/100. So, the denominator becomes the numerator, and the numerator becomes the denominator. If 100 cancel 100, you have 1. 1 times 1, 1/3 times 1, 3. So the fraction becomes 1/3. That means no bad debts. You can't recover anything from it. But the doubtful debts, you were told you can only realize 1/3. So calculate 1/3 of 18,000. That gives us 6,000. That means you can realize 6,000 naira from doubtful debts. So you put 6,000. Doubtful debts, 6,000. Back to the question. Now, why the cost in arrears fails to produce? Cost in arrears fails to produce. That is to show that the realizable value of cost in arrears is 0. The realizable value of cost in arrears is 0. So since it is 0, it doesn't have any value. Note C. The payables include preferential claims of 30,000. Payable is a liability. Then the estimated costs and expenses of the liquidation are legal, 10,000. Liquidators' remuneration of 5,000 plus 5% of the amount distributed to members. Note E. The debenture interest has been paid to date. Note F. The preferential capital plus the arrears of dividend to date of winding up are to be settled at a premium of 3 kobo per share before the ordinary shares. Note G. The bank overdraft has a floating charge on the assets of the company. So now, let's sum this up. Now, asset not specifically pledged is totaled. Now, let's sum it up. 4,150 plus 138,900 plus 24,100 plus 62,700 plus 35,000 plus 6,000. So you have 270,850. So the asset not specifically pledged is totaled 270,850. After asset not specifically pledged, the next item is asset specifically pledged. If you go back to the question, the only asset that is pledged on 8% debenture is freehold properties. Freehold properties is the only asset that is specifically pledged. So now let's have assets specifically pledged. Assets specifically pledged. This one include freehold property. How much is the realizable value of freehold properties? Freehold property, the realizable value is 187,400. 187,400. So if you add it now, the realizable value of the entire asset now will be 278.50 plus 187,400. So the realizable value of the entire asset is 458,250. So after the total assets, you have the liabilities, the settlement of the liabilities. So we have expected to rank. Expected to rank. Now we have secured. If you apply the model SEC, the bunch I've given you earlier, this SC stands for secured creditors. Secured creditors include 8% debenture. That is the creditor that is secured. So, and which is secured, 8% debenture secured on freeholds. And that amounted to 80,000 naira. 80,000 naira. After secured creditors, the next thing is cost. What are the expenses incurred? The various expenses incurred on liquidation or cost of liquidation. Back to note D. The estimated cost and expenses of liquidations are, so now let's have legal cost of 10,000 naira. Legal cost 10,000 naira. After legal cost, we also have liquidators remuneration, 5,000. The 5,000 is a fixed remuneration plus 5% of the amount distributed. The 5,000 is fixed. The variable one is 5%. So we have liquidators remuneration. The fixed one is 5,000. 5,000. After fixed, the next one will be variable one, which will be calculated. We are going to calculate the variable remuneration. So let's leave that for now. So we've done with note D. After secured, after cost of dissolution, the next item is preferential creditors. Which one is preferential? You go back to the question, no C. You were told the payables include preferential claims of 30,000. So that's to show that the preferential creditors is 30,000. Now let's have preferential creditors of 30,000. 30,000. 30,000. That is preferential creditors. After preferential, we have the debenture. But remember, I've told you earlier that the debenture we need here is a floating one, a floating debenture. Let's go back to the notes and try to ascertain if there is any floating claims or floating debenture. The preferential capital plus arrears of dividend arrears of dividend to date of winding up are to be settled at a premium of this. Then the bank overdraft has a floating charge. You were told the bank overdraft, it has a floating charge. Since it has a floating charge, so that is the one to be considered next. So bank overdraft. You were told it has a floating charge. So now, how much is the bank overdraft? You were told bank overdraft is 43,000. Bank overdraft is 43,000. 43,000. After bank overdraft, we've considered this. The next item is unsecured creditors. Unsecured creditors. How much is unsecured creditor? Let's go through the question. These are share capital. These are contributory. I've told you that the share capital, we call them contributory. So this is an asset has been considered their realizable value, investment stocks, receivables, trading loss. The pension has been considered cost in hands. Cash in hands has been considered cost in arrears and advance, preference dividend, the bank overdraft. Then, okay, you have receivables and the payables. Receivables and the payables. This is the payables. Payable is 97,000. Our payable, the receivable is 58,400 because we are giving receivables and payables together. This is receivable and this is payable, 97,000. But you were told from the footnote that the payables include preferential claims of 30,000. If preferential claims of 30,000 has been included, that is 30,000 preferential claims has formed part of the 97,000. Therefore, if you remove 30,000 from 97,000, which is your payables, then the remaining one is unsecured. So we have payables now. Payables is an unsecured creditors. The book value is 97,000. Then minus preferential of 30,000. Then you'll be left with 67,000. So we've considered the unsecured creditors. The next thing is shareholders. I've told you that this shareholder, this class, we call them contributory. We call them contributory. Before the contributory, now we want to calculate the liquidator's remuneration, the variable one. We want to calculate the variable remuneration of the liquidator. Now, I've told you that to compute the variable one, now let's calculate all the liabilities. 80,000 plus 10,000 plus 5,000. Total, let me just say total liabilities. Total liabilities so far. We have 80,000 plus 10,000 plus 5,000. 5,000. 80,000 plus 10,000 plus 5,000 plus 30,000 plus 30,000 plus 43,000 plus 67,000. This is the total liabilities. So total liabilities now, total liabilities. 80 plus 10, that is 90. 90,000. 90,000 plus 5,000, that is 95,000. 95,000 plus 30,000 plus 43,000 plus 67,000. The sum of all the liabilities is 235,000. 235,000 naira. Now, if you go back to the notes on the liquidator's remuneration, you were told 5,000, which is the fixed remuneration, plus 5% of the amount distributed to members. How much will be available for distribution? The realizable value of all the assets is 458,250. Therefore, amount distributed will be 458,250. 458,250 minus the total liabilities of 235,000. So amount distributed will be 458,250 minus 235,000. So we have 223,250. 223,250. So the variable liquidator variable remuneration. Remember, you have been given the liquidator remuneration The fixed remuneration is 5,000, while the variable remuneration is 5% of the amount distributed to members. So, since it is 5% of the amount distributed, you have 5 over, I've told you we are going to add that 5% to 100%. The denominator becomes 105 times 223, 250. 223, 250. So, times 5 divided by 105. So you have 10,631. So the variable remuneration is 10,631. So the liquidator's variable remuneration, which is 10,631. So you now sum up all the liabilities now, including the fees and variable remuneration. Now let's sum up all the liabilities. The total liabilities is 245,631. That is the total liabilities. If you now subtract the total liabilities from the total realizable value for all the assets, you get estimated surplus after the settlement. The settlement of the liabilities. Now, how much is the realizable value of the assets? Now, the realizable value of all the assets is 458,250. Now, you now subtract the sum of all the liabilities from that realizable value of all the assets. Then the net difference is 212,619. 212,619. This is the balance available for distribution to the contributory. Amount available for distribution to the contributories. Now, remember, I've told you that the contributories are the shareholders. The first settlement, preference shares, will be ranked prior to ordinary shareholders. So we have preference shares. The preference shareholders will receive the preference share capital, 10% cumulative preference shares. That is 100,000. 100,000. Remember, the preference shares, you are given preference dividend half year to September 2023, 5,000. This is up to September 2023. And if you go back to the note F, you were told that the preference share capital plus the arrears of dividend are to date of winding up are to be settled at a premium of 3 kobo per share before the ordinary shares. So that means preference shares, since they were to be settled before the ordinary shares, that means preference shares is to be ranked prior to ordinary shares. They are not to be ranked in pari passu. So since both ordinary and preference shares are not to be ranked in pari passu, preference shareholders will be ranked prior to ordinary shares. No, the arrears of dividends to the date of winding up. What is the date of winding up? The date of winding up is March 20x4. If the date of winding up is March 20x4 and dividends were paid up to September 20x3, let's count from September 20x3. We have October, November, December. That is December 20x3. January 20x4, February 20x4, and March 20x4. That means arrears of dividend now. Preference dividend arrears is 6 months now. 6 months dividend is in arrears. The rate of dividend is 10%. Now calculate 10% of preference shares, and our preference share is 100,000. 100,000. And in dividend in arrears is 6 months dividend. Half year dividend is in arrears. 10% of 100,000, that will be 5. 10% of 100,000, that will be 10,000. 10,000 times 6 over 12, that will be 5,000. The arrears of dividend is 5,000. Then, in that same note F, aside the dividend, No, they are to be settled at a premium of 3 kobo per share. Premium now. Premium on preference shares now. Premium on preference share. 3 kobo, which is 3 over 100 times 100,000. That also gives us 3,000. So the amount due to preference shareholders, if you sum it up, that will be 108,000. 108,000. If preference shareholders, if they are to receive 108,000, remember the total amount you are left with for distribution to the contributories is 212,619. So if you subtract 108,000 from 212,619, 212,619 minus 108,000, you'll be left with a balance of 104,619. That is the balance available for distribution to the ordinary shareholders. So this is the surplus after distribution to preference shareholders. That is the surplus. Then this surplus will be available for distribution to the ordinary shareholders. And if you look at the question, you are given the ordinary shares of 1 naira each, 200,000. If ordinary share is 200,000, ordinary share is 200,000. If you subtract this from the surplus left, the remaining ones will be the deficiency, minus 200,000. Then you have deficiency of 95,381. That is the deficiency. This deficiency will be suffered by ordinary shareholders. It will be borne by ordinary shareholders since the claims of the preference shareholders will be met in full. It's ordinary shareholders that their own claims will not be met in full. From 200,000, they will only get 104,619, which is 104,619 divided by 200,000. That is the amount they are going to get per share. So the remaining ones, they are going to lose it. If you have 95,381 divided by 200,000, that is the amount they are going to lose per share. That is their loss per share. Deficiency account. So we want to prepare deficiency accounts. So remember, I've told you that to prepare the deficiency account, you are going to start with items contributing to deficiency. Items contributing to deficiency. Those items that will make the deficiency to increase. Items that will make the deficiency to increase, they are the items that contribute to deficiency. Now, do we have any loss? You have trading loss. Trading loss. Losses contribute to deficiency. Let's check if you have profit. We also have profit and loss. Profit of 28,700. We have profit of 28,700. And then we also have loss of 42,550. Net trading loss. So we have profit. The profit is 28,700. While loss is 42,550. Profit 28,700. Loss 42,550. So the net trading loss now will be 28,700 minus 42,550. Then we have net loss of 13,850. That is the net loss, net trading loss. Item contributing, because loss is greater than profit. That is why we have net loss of 13,850. Now, Let's go through the question. You check the book value. You compare the book value of the individual assets with their realizable value. For instance, the book value of freehold properties is 180,000. How much is the realizable value of the same freehold properties? The realizable value is 187,400. Since the realizable value is greater than the book value of 180,000, that means it will reduce the efficiency. This will give rise to profit because the amount it will be sold is more than their book value. It will be sold above the book value. So it will give rise to profit. Profit reduces the efficiency. So plant and machinery book value is 155,000. How much is the realizable value of plant and machinery? Realizable value is 138,900, which is lower than the book value. Loss from this disposal of plant and machinery. The book value of plant and machinery is 155,000. And the realizable value of plant and machinery is 138,900. 138,900. This is giving rise to a loss of 16,100. That loss will contribute to deficiency. Now, after plant and machinery, we have investments. The book value of investment is 28,000. How much is the realizable value of investments? The realizable value of investment is 24,100, which is greater than the book value. So that means investment will be sold at a loss. Investment with the book value of 28,000 and the realizable value is 24,100. It is a loss because the realizable value is lower than the book value. So 28,000 minus 24,100. So the loss is from sales of investment is 3,900. Then after investment, we have stocks and work in progress. The book value is 79,600. And how much is the realizable value of stocks and work in progress? The realizable value is 62,700, which is lower than the book value. So stocks and work in progress. The book value of stocks and work in progress is 79,600. The realizable value of stocks and work in progress is 62,700. 62,700. Loss is 79,600 minus 62,700. Loss of 16,900. Then we also have receivables. So 58,400. So receivables, the bad debts now. Bad debts. That is from your receivables. So remember, the good debts is realized in full. If you add up all this, good 35,000 plus doubtful 18,000 plus bad 5,400. The total of these three is 58,400. If you compare it with the one in the trial balance, 58,400, the two amounts are the same. Now, how much of this actually become bad? Remember, you were told that the doubtful debts are estimated to realize 33 over 1/3. And we've converted this to fraction the other time. And we got 1/3. We calculated 1/3 of 18,000. And we got 6,000 from our statement of affairs. So the good one from your doubtful debts is 6,000. That means, we had 18,000 plus 5,000 minus the good one. So 18,000 plus 5,400, which is bad, minus good one from the doubtful debts. The good one is 6,000. So 18,000 plus 5,400 minus 6,000. So the bad debt is total 7,400. This 17,400. This bad debt from this 18,000, 6,000 are good. So good, that means the bad debts from this 18,000 is 12,000. 12,000 plus 5,400, the total bad debt is 17,400. Or you just have 18,000 plus 5,400 minus 6,000. Take note of that. After receivables, trading loss has been considered. This debenture is a liability. Cash in hands is an asset which has been considered earlier because it is realizable in full. Call in arrears is 6,000. Call in arrears is 6,000. And you were told earlier that call in arrears failed to produce. Since call in arrears failed to produce, that means the whole 6,000 is lost completely. It will be written off. So we have call in arrears of 6,000. Call in arrears 6,000. Now preference dividend. Preference dividend. The outstanding preference dividend that is to be paid now will also contribute to deficiency. Arrears of preference dividend. Arrears of preference shares dividend. It will also contribute to deficiency, and which has been calculated earlier, 8% of 100,000 for 6 months calculated earlier, and we got 5,000. It will contribute to deficiency. So when it's because it's going to be paid. Then we also have a premium on redemption of preference shares. Premium on redemption of preference shares that you were told is 3 kobo, 3 over 100 times 100,000. This has been calculated when we're preparing the statement of affairs. That premium is 3,000. So then we also have liquidation expenses. It will also contribute to deficiency. Liquidation costs or legal expenses 10,000. Legal expenses. Legal expenses, that is 10,000. After legal expenses, we have liquidators remuneration. That will also contribute to deficiency. Liquidators remuneration, which was divided into two. The fixed remuneration, which was given to be 5,000 in the question, 5,000, and variable, which has been calculated variable, and we got 10,631. 10,631. Outstanding preference shares dividend is 5,000 naira. And the amount that has been paid for half year is also 5,000. So you either add that 5,000 to this to make it 10,000, or let me put it separate. Preference share dividend paid to September 20x3, and that one is 5,000. Remember, this 5,000 is the amount that is due to be paid, and this has been allowed for in our statement of affairs. Now, how much is the sum or the total of the items contributing to deficiency? Now we have 13,850. 13,850 plus 16,100 plus 3,900 plus 16,900 plus 17,400 plus 6,000 plus 5,000 plus 3,000 plus 10,000 plus 5,000 plus 10,631 plus 5,000. The items contributing to deficiency is totaled 112,781. After items contributing to deficiency, we have items reducing deficiency. Items reducing deficiency. Items reducing deficiency. Now, back to the question. Remember earlier, freehold properties is sold at a profit. It's realized at a profit because the book value of 180,000 is lower than the realizable value of 187,400. Profit from sales of freehold property. Profit from sale of freehold property. The realizable value is 187,400 and the book value is 180,000. Then you have the profit of 7,400. Then you also have costs in advance. You have costs in arrears, stroke advance. Cost in arrears is 6,000, while cost in advance is 10,000. Cost in advance, cost in advance. That is 10,000. 10,000. If you add 10,000 to 7,400, then you have 17,400. So if you subtract 17,400 from 112,781, you have 95,381. 95,381. This is the deficiency as per statement of affairs. Deficiency as per statement of affairs. Statement of affairs. That is 95,381. If you compare this figure with the deficiency we got in statement of affairs, you will discover that the amounts are the same. Now, this is our statement of affairs. This is where it ended. And we have the deficiency of 95,381, which agrees with what we have in our deficiency account. This is the end of this presentation on liquidation account. My next lecture on liquidation account, I will examine liquidator's final account. Thanks for watching ZICA. Please don't forget to like the video.